Listen carefully, because if you currently hold 500 ounces of silver, you need to understand that the environment around your position is changing in ways that most investors still fail to recognize. I am not talking about a routine market fluctuation. I am not talking about a temporary burst of enthusiasm that fades after a few weeks of headlines. I am talking about a deeper shift taking place beneath the surface of the global financial system, one that has the potential to redefine how wealth is protected during the years ahead. Most people continue to look at markets through the lens of the last cycle. They assume the structures that supported growth, confidence, and asset appreciation will continue operating the same way they always have. They assume policymakers will maintain stability. They assume debt can continue expanding without creating consequences. They assume confidence is permanent. History shows otherwise. The greatest financial transitions rarely announce themselves at the beginning. They emerge quietly while the majority remains focused on short-term events. By the time the public fully understands what is happening, much of the repositioning has already occurred. That is why understanding matters now. You need to recognize that silver is no longer simply a metal sitting inside a portfolio. Its importance comes from what it represents during periods when confidence in traditional financial structures begins facing pressure. When investors trust the system completely, capital behaves one way. When trust begins weakening, even gradually, capital behaves very differently. This is where most people miss the larger picture. For years, markets were supported by easy liquidity, expanding credit, and the belief that central banks could solve nearly every problem. Debt increased across governments, corporations, and households because borrowing remained inexpensive and widely available. Asset prices benefited from that environment. Risk-taking was rewarded, speculation flourished. Stability appeared unquestionable, but every cycle creates excesses. When debt reaches sufficient scale, maintaining the system becomes increasingly difficult. Interest expenses begin growing. Fiscal pressure expands. Refinancing becomes more challenging. Economic growth slows under the weight of obligations accumulated during earlier periods of expansion. These developments do not appear overnight. They build gradually until the underlying pressure becomes impossible to ignore. This is not speculation. This is how debt cycles have operated throughout modern financial history. The real question is not whether pressure exists. The real question is how markets respond once enough participants begin recognizing it. That recognition process is already underway. Investors are starting to question assumptions that once appeared untouchable. Governments continue running large deficits. Central banks face difficult trade-offs between supporting growth and preserving purchasing power. Consumers face rising costs. Businesses face higher financing burdens. Each challenge alone may seem manageable. Together they create a more fragile environment than many people realize, and fragility changes behavior. When confidence weakens, capital begins searching for assets that cannot be created through policy decisions or accounting entries. Investors start looking beyond promises and toward scarcity. They begin evaluating assets differently. They begin focusing on preservation as much as growth. This is one reason silver becomes increasingly important during periods like these. But there is another force developing at the same time. Silver is not only connected to monetary concerns, it is deeply connected to industrial demand. Modern economies require silver for technologies that continue expanding across the world. Energy's infrastructure, advanced electronics, communication systems, medical applications, industrial manufacturing, and emerging technologies all depend on properties that silver provides exceptionally well. That demand is not driven by market sentiment. It is driven by necessity. At the same time, increasing supply is not simple. Mining projects require years of development. Costs continue rising. Regulatory hurdles remain significant. Production growth often struggles to keep pace with long-term demand trends. These realities create conditions that deserve serious attention. Now think about what happens when monetary demand and industrial demand begin strengthening simultaneously. That is where the conversation becomes far more interesting. Most investors analyze silver through only one lens. They focus on inflation. They focus on fear. They focus on temporary market reactions. But silver exists at the intersection of several powerful forces at once. Debt pressure, monetary uncertainty, industrial expansion, supply limitations, capital rotation. When multiple structural forces begin pointing in the same direction, markets can change far faster than people expect. This is why I believe many investors remain dangerously focused on the wrong signals. They watch daily price movements. They react to headlines. They wait for experts to provide certainty, but certainty rarely arrives before major transitions begin. The majority always wants confirmation first. They want validation from institutions. They want unanimous agreement from analysts. They want the media to explain why conditions have changed. Yet by the time that confirmation becomes widespread, much of the opportunity has already passed. History has proven this again and again. Large financial shifts begin with disbelief, then they move into recognition, then they accelerate as capital rushes toward the same conclusion. Right now, we are still closer to the early stages than most people realize. If you own 500 ounces of silver, you should understand that your position represents exposure to forces extending far beyond a simple commodity trade. It represents exposure to changing monetary conditions, growing debt stress, constrained supply dynamics, and a world increasingly dependent on the unique role silver plays inside modern economic systems. Most people are still completely blind to that reality, but the environment is changing. And in the next part, I want to explain why the behavior of governments, central banks, and institutional capital may become one of the most important developments silver holders need to watch very carefully. Stop for a moment and look beyond the daily noise, because this is where many investors make their biggest mistake. They assume financial systems change suddenly. They imagine a single event, a single headline, or a single crisis creating an immediate transformation. But that is rarely how major transitions unfold. The reality is much more subtle. Systems weaken gradually before they adjust visibly. Confidence erodes quietly before markets fully reflect the change. Capital begins moving long before the broader public understands why. That is why understanding institutional behavior matters so much right now. Large pools of capital do not operate the way retail investors operate. Institutions rarely wait for certainty. They study probabilities. They examine structural trends. They identify developing risks before those risks become obvious to everyone else. When enough evidence begins pointing toward instability, they start repositioning, not dramatically at first, not in ways that generate headlines, but gradually. And those gradual movements often become the foundation of much larger shifts later. This is particularly important in the current environment because the pressures facing policymakers are becoming increasingly difficult to manage simultaneously. Governments need economic growth. They need stable financial markets. They need manageable borrowing costs. They need public confidence. Yet achieving all of those objectives at the same time becomes harder when debt burdens continue expanding. You need to understand the challenge. If policymakers keep monetary conditions tight for too long, debt servicing pressure increases. Growth slows. Credit becomes harder to obtain. Weakness begins appearing across sectors dependent on financing. But if policymakers move too aggressively toward easier conditions, they risk creating new inflationary pressures and weakening confidence in currency purchasing power. This is the dilemma, and it is not unique to one country. It is appearing across multiple major economies simultaneously. The financial system has become deeply dependent on debt expansion over many decades. Growth has often been supported by borrowing. Consumption has often been supported by borrowing. Asset appreciation has often been supported by borrowing. The result is a structure that requires careful management simply to maintain balance, but balance becomes more difficult as debt levels climb higher. History has demonstrated that every debt-driven cycle eventually reaches a stage where policymakers face increasingly limited options. None of the available choices are perfect. Every solution introduces additional complications. Every intervention creates new trade-offs. This never ends as cleanly as most people expect. That is why investors who focus only on short-term economic reports often miss the larger story. The larger story is that confidence itself becomes increasingly important during periods of elevated debt pressure. Once confidence begins weakening, behavior changes, investors become more defensive, institutions become more selective, capital becomes more cautious, and assets that were previously ignored begin attracting attention. Silver has experienced this pattern before. For extended periods, it remains overlooked because other opportunities appear more attractive. Capital chases growth. Risk appetite remains strong. Speculative assets dominate conversations. During those phases, precious metals often receive very little attention. Then conditions begin shifting. Investors start reassessing risk. Concerns about purchasing power grow, questions about long-term monetary stability become more common, and suddenly assets that spent years on the sidelines begin moving back into focus. The majority always acts as if these transitions arrive without warning. But warning signs usually exist long before recognition becomes widespread. We are seeing many of those signs today. Global debt remains extraordinarily large. Deficit spending continues. Economic growth faces increasing challenges. Currency purchasing power remains a concern for millions of people around the world. And financial markets continue depending heavily on confidence in institutions maintaining stability. None of these factors should be viewed in isolation. Together they form a broader picture. That broader picture suggests the next phase of the cycle may look very different from the one investors became accustomed to over the last decade. Now bring silver back into this discussion. One of the most important characteristics of silver is that it occupies a unique position between monetary demand and industrial demand. Most assets benefit primarily from one source of silver benefits from multiple sources simultaneously. That distinction matters. If investors become more concerned about monetary stability, silver can benefit. If industrial demand continues expanding through infrastructure, technology, and energy development, silver can benefit. If capital begins rotating toward hard assets, silver can benefit. If supply growth remains constrained while demand grows, silver can benefit. Few assets possess that combination. And when several supportive forces begin strengthening at the same time, the resulting impact can be much larger than many investors initially expect. The key point is not predicting an exact future price. Too many people become obsessed with specific targets. They focus on numbers instead of understanding. But understanding is what allows investors to maintain conviction during uncertainty, because uncertainty is guaranteed. Volatility is guaranteed. Conflicting opinions are guaranteed. Financial media will continue presenting contradictory narratives. Analysts will continue disagreeing. Market fluctuations will continue testing confidence. That is normal during major transitions. What separates successful participants from unsuccessful participants is often their ability to understand the deeper forces operating beneath the surface. The investors who struggle most are usually those who rely entirely on external validation. They need consensus before taking action. They need reassurance before maintaining conviction. They need certainty before believing conditions have changed. But markets rarely reward that approach. The largest shifts often occur before consensus forms. That is why smart capital studies structure rather than headlines. Structure reveals what headlines often miss. And structurally, several important forces are beginning to align around silver in ways that deserve attention. Debt pressure remains elevated. Monetary uncertainty remains present. Industrial demand continues developing. Supply growth remains constrained. Capital preservation is becoming increasingly important. When these conditions appear together, ignoring them becomes difficult. If you currently hold 500 ounces of silver, you need to recognize that your position may represent something much more significant than many investors realize today. The real question is not whether volatility will occur. It will. The real question is whether you understand the larger transition well enough to interpret that volatility correctly, because in the next part, I am going to explain why major wealth transfers often occur during periods exactly like this, and why the psychology of the average investor becomes the single greatest obstacle to capturing the full benefit of a developing transition. Now listen carefully, because this is where the majority of investors lose their advantage, even when they correctly identify the direction of a major transition. The problem is rarely information. The problem is psychology. Most people believe wealth is built by finding opportunities. In reality, wealth is often built by maintaining conviction during periods when opportunities are misunderstood by the crowd. That distinction matters enormously. When a market begins a structural repricing process, it almost never unfolds in a straight line. There are advances, pullbacks, conflicting narratives, and periods of uncertainty. Every stage creates emotional pressure. Every stage tests patience. Every stage encourages participants to abandon positions before the full transition develops. This is how major wealth transfers occur, not because information is hidden, not because opportunities are invisible, but because emotional reactions prevent most participants from staying aligned with the underlying trend long enough to benefit from it. History has demonstrated this repeatedly. During every significant financial transition, the majority initially dismisses the possibility that anything important is changing. They assume the existing framework will continue functioning indefinitely because that framework feels familiar. Familiarity creates comfort. Comfort creates confidence, and confidence often delays recognition. Then the first signs begin appearing. Volatility increases, market behavior changes, unexpected developments emerge, but instead of questioning assumptions, most investors search for explanations that allow them to maintain their existing beliefs. That is human nature. People naturally resist the idea that large structural shifts may be underway because accepting change requires reevaluating deeply held assumptions. Eventually, the evidence becomes harder to ignore. Capital begins moving. Certain asset classes begin outperforming, narratives start evolving. Analysts who previously dismissed the trend begin discussing it more seriously. At that stage, recognition starts spreading, but even then, most participants remain hesitant. They wait for more confirmation. They wait for more certainty. They wait for greater consensus. And while they wait, the transition continues progressing. This is why the largest gains in many historical cycles often occur before the majority becomes fully comfortable with the underlying thesis. Comfort arrives later, recognition arrives later, consensus arrives later. Price adjustment often arrives first. That sequence is extremely important. If you own 500 ounces of silver, understanding that sequence may be more valuable than understanding any specific forecast, because forecasts change. Predictions change, market narratives change, but human behavior remains remarkably consistent. The majority always seeks reassurance. The majority always wants certainty. The majority always assumes there will be plenty of time to react later. History suggests otherwise. The most important transitions often accelerate once broader recognition begins. What seemed slow suddenly becomes fast. What seemed unlikely suddenly becomes obvious. What seemed speculative suddenly becomes accepted. And once that shift occurs, positioning becomes far more expensive. This is one reason I continue emphasizing structure over prediction. The deeper issue is not whether silver reaches a particular number next month or next year. The deeper issue is whether the forces supporting silver are becoming stronger or weaker. Right now, many of those forces appear to be strengthening. Debt pressure remains substantial. Monetary uncertainty remains unresolved. Industrial demand remains significant. Supply constraints remain relevant. Institutional interest in hard assets continues attracting attention. These developments do not guarantee a specific outcome, but they do create conditions that deserve serious consideration. Most investors underestimate the importance of multiple forces converging simultaneously. A single supportive factor can create opportunity. Several supportive factors working together can create something much larger. That is why periods like this deserve careful attention. Silver is not operating within a vacuum. It is connected to broader questions about monetary policy, fiscal sustainability, industrial development, resource availability, and investor behavior. Those connections matter. As confidence in traditional assumptions begins facing pressure, assets positioned outside those assumptions often become increasingly attractive. This process does not require panic. It does not require crisis. It simply requires changing perceptions. And perceptions can change surprisingly fast when enough evidence begins accumulating. Look back across financial history and the pattern becomes clear. Long periods of complacency are often followed by periods of reassessment. Long periods of confidence are often followed by periods of caution. Long periods of neglect are often followed by periods of recognition. Silver has spent years operating in an environment where many investors viewed it as secondary, unimportant, or unnecessary. That perception may not remain permanent. As larger structural pressures continue developing, more investors may begin reevaluating the role that tangible scarce assets can play inside a diversified strategy. If that happens, the implications could become significant because the silver market remains relatively small compared with the scale of global capital. That is another detail many people underestimate. It does not require an enormous shift in investor behavior to create meaningful pressure inside a market with limited size and constrained supply. Even moderate reallocations can have disproportionate effects. This is why major repricing events often surprise people. They assume changes will occur gradually. Instead, recognition reaches a tipping point and adjustment accelerates. By then, the conversation changes completely. The same asset that was ignored becomes discussed everywhere. The same opportunity that seemed uninteresting becomes attractive. The same investors who dismissed the trend begin explaining why it suddenly matters. That cycle has repeated many times before, and it may be beginning again. So if you currently hold 500 ounces of silver, understand what that position potentially represents. It represents exposure to scarcity. It represents exposure to monetary uncertainty. It represents exposure to industrial expansion. It represents exposure to capital-seeking protection during periods of structural adjustment. Most importantly, it represents participation in a market that may benefit from several powerful forces aligning at the same time. Whether those forces fully develop remains to be seen. But the conditions forming today deserve far more attention than most people are giving them, because history has proven repeatedly that the biggest financial transitions are usually recognized by the majority only after they are already underway. And when that recognition finally arrives, the opportunity to position early has often disappeared.